Gentlemen, so you normally would have expected my colleague Lutz to speak here. Unfortunately, you have to live now with my presentation. But for me, it's a great pleasure, obviously, to be the first time here at your Congress. And Mr. Karpowitz, who had the pleasure to join former conferences, told me that this would really be a good opportunity to talk about global economics, to give you more a bird's eye view. I'm not an expert in the steel industry. I'm not an expert in commodity prices. What I want to give you is basically a bird's eye view on global economy. And unfortunately, as Eric has told you, the outlooks for global economy are not fantastic. Therefore, this is not a good part of the message that I can deliver to you here. I don't want to repeat basically the numbers that we and others are forecasting. Ours are not so spectacularly different to others. We are expecting only sluggish growth in Europe, obviously problems in those countries that are commodity exporters, because even if commodity prices don't fall further, even if they recover somewhat, a lot of those economies that are commodity exporters have to adopt to these new lower levels of commodity prices than we and the markets in general are expecting to prevail, at least for the foreseeable future. And in the US, situation is a little bit better. Here, growth rates might be okayish, but in general, the picture for the global economy is not very bright. And this is something which should astonish you and me, and basically I am astonished, because we are in an environment where policymakers, especially monetary policymakers, the central banks of this world, have done for so long time everything to spur growth and inflation, but this has not succeeded so far. You know, we see ultra-expansionary monetary policies basically since the Great Recession of 2008 and 2009. Since then, many central banks have cut their interest rates to extremely low levels, to negative levels even in some countries. Many are doing a lot of other things like QE programs, buying government bonds or other assets to inject liquidity into the economies. And nevertheless, I'm still here after so many years of these extraordinary monetary policies, frankly, of policies that I would have never believed would be possible only 10 years ago. And I still have to tell you that the outlook for the global economy is not bright. Therefore, something is not working normally. Something is wrong in the way the global economy is working at the moment. Because otherwise, all these policy measures should have led us to a situation where I should tell you that global economy would grow extremely well, where inflation would pick up quite considerably. This is not the case, therefore something must be wrong. And I think something is wrong in the way monetary policies work. That will be my first topic, and something is at least different compared to the past when it comes to China. And therefore, Eric, you've spoken about China quite a lot. Others will speak about China. I cannot leave this out from my presentation because this will be a very important topic also for the development of the global economy. You guys, and you, Eric, you are the experts on the steel market. I want to give you here also more some broad macroeconomic perspective on the developments, which might help to understand a little bit of what's going on there. Well, something's not working properly, and a lot of people are expecting something like the picture I put you on the first slide. There are more and more people who are saying, are we just ahead of a new crisis? I mean, we came out after the 2008-2009 recession in the global economy relatively quickly, with regional differences here in Europe due to the government bond debt crisis that we saw afterwards in some countries, not as quickly as in other regions. But in general, we came out relatively quickly compared to the fact that this was such a sharp recession, basically the largest recession in the post-World War II period that we saw in the global economy. Are we just ahead of something similar? This is something a lot of people, or more and more analysts are forecasting at the moment. I'm not in this camp, but also I'm not very optimistic. And the one problem that monetary policy has is at the moment that normally those expansionary monetary policies would spur inflation and would spur economic growth. And this is a mechanism that's not working properly at the moment. Monetary policy does not have the desired effects. What I put here on this chart is the average inflation in the G10 countries, basically in the Western industrialized countries. I left out emerging markets because in emerging markets we have a lot of different effects. We have normally very different normal levels of inflation. In the G10 countries with relatively similar economic structures, we can compare them better. Therefore, I put in inflation here, the average inflation in the G10 economies. And central banks want to keep this average inflation around 2%. And they succeeded more or less very well in the early 2000s. Then inflation picked up before the crisis. Central banks got more restrictive. They triggered the housing crisis in the US and subsequently the Great Recession of 2008, 2009, where prices dropped and inflation rates were negative, actually. This is not such a big surprise. In such a big recession, it's normal that prices are falling. Overall, commodity prices are falling, consumer prices are falling. That's a normal thing. And therefore, afterwards, when the recession was over and prices recovered, everybody thought, well, we are back in this old normal world where a recovery of the global economy is also leading to a pickup in prices. And then suddenly something happened which was very astonishing. Price inflation started to come down very significantly. In the later phase, also amplified by falling oil prices and falling commodity prices in general. But at least in this first stage where commodity prices held up in 2012, 2013, this is not the explanation. Therefore, there must be something very different to the way economies work. And the problem is that at the moment, central banks have not found a good measure to tackle this problem. And therefore, they are also creating more uncertainties in financial markets, and they are not able to reach the desired effects on real economies, on global growth. Well, somehow I cannot switch to the, here it is. I mean, central banks reacted very, very strongly to that one. You see in the yellow bars, again, for the G10 countries, the range of key policy rates that the central banks have set in the last 20 years. And the gray bars are where the policy rates are at the moment. We are at absolutely low levels in Europe, in Japan, in the UK, in Switzerland, near the lowest levels in the US and in Canada. Therefore, central banks are doing things they never have done before. They have lowered interest rates to levels we have never seen in the last 20 years. They've even lowered them to negative rates in Japan, a little bit negative, you hardly see it there, in Europe, in Switzerland, in Sweden. Why is this not helping? Why are they not spurring growth in global economy? I mean, with such low interest rates, you normally would expect that we have an environment where investment would be highly profitable. It's not only the central bank's interest rates that have gone down, but also market rates for long-term debt have gone down. Therefore, basically, refinancing conditions should be very favorable for investment, should be very favorable for consumption. Because if interest rates are so low, it's not paying out to save very much, and therefore, normally central banks would expect that people also don't save very much but consume more. Therefore, investment demands should be strong, consumption demands should be strong. We should have a world economy that is booming. By the way, I've also only put it here in again for the G10 central banks, because here also the historical comparison is easier. But also for a lot of emerging markets, we are seeing very low interest rates. We are seeing interest rates at or below inflation rates, which is normally the indication of a very relaxed monetary policy. So this is not working normally. And frankly, I'm in a very difficult situation standing here in front of you, having to explain to you why this is not working, because basically economic theory lacks a good explanation for this one. We're basically in a situation where, well, Central banks are in a very difficult situation. They don't know what to do. The Swedish central bank governor, Mr. Ingves, a couple of months ago said it in a very bold way. In his country, they have growth rates of 3%, above 3% slightly even. Therefore, the Swedish economy is growing very well, but they have negative inflation rates. And he told journalists at the conference, frankly, I don't know how this can happen. With our standard macroeconomic models, it would be impossible to have such a combination of high growth rates and low inflation rates. And but we don't have any good economic theory to explain it. Therefore, we have to stick to our old theories and do what we have always done in these situations when inflation is low. Basically, we are keeping on with our expansionary monetary policies. This is a similar situation like the economic theory was in the 1930s, where we had the Great Depression in the US and in other countries, which was not explainable by the economic theory they had at that time. New theories came up later, and we are now able to explain the Great Depression in the US. It's a similar situation like in the late 1970s, where we had a combination of low growth rate and high inflation, which was also not explainable by the theory at that point in time. New theories came up, new macroeconomic models came up, and now we are also able to explain what happened in the 70s. We are now in a situation where we again have a situation with this low inflation instead of very expansionary monetary policies, which is not explainable by our theories. We have no good model at hand to explain it at the moment. And therefore, the only way central banks can react on this situation is to continue doing what they have done in the last years, hoping that doing more, doing this kind of policy longer, will at some point help. The risk is that this is something which is not getting better over time, but the risk is that these monetary policies are pulling us to a situation where things get worse by these monetary policies. That's a fear that I have regarding the global macroeconomic environment and regarding global growth in general. Because a lot of central banks tell you, yes, we know that our measures are not working normally. I mean, they are not no stupid guys there. They're very intelligent guys in most of the central banks. But they have no other choice than continue doing what they are doing, hoping that doing more, doing it longer will help. But what if the policies that they are implementing are not only not working normally, not having the desired effect at a scale, at a level they want to, but what if they really are counterproductive? That's a fear that I have. I fear that these policies will lead us to a situation where the global economy, or at least the Western economies, might end up in a scenario like Japan is in the last basically 25 years, where we have basically zero inflation. In Japan, consumer prices today are, if you correct for tax effects, are at the same level as they were in 1991. Now you can say, what's so bad about zero inflation? I mean, stable prices, if you all expect stable prices, we can perhaps live with this. But in Japan, we see that this is also having an effect on long-term growth potential. That's not easy to explain for an economist, I must confess. But I always like to give a very simple story. Let's say you're a boss and you have two employees, and let's assume a situation where we have 2% inflation rates. Now, if you have two employees and one is it's a lazy guy and one is working very hard. You might give the one who's working very hard 4% wage increase, and the one who is lazy, you give 0% a wage increase. Now you have a differentiation with 4 percentage points. Let's assume a situation where you have zero inflation. Then if you want to give the one who is working very hard a little bit more, you have to give the one who is lazy less. And this is sometimes a problem. This can be legal problems in some countries. This can be social problems. It's not so easy to cut wages than to increase wages. Therefore, wages are not as flexible to the downside than they are to the upside. Which means it's hard for you to give the lazy one less money than the year before. And the only choice you have then is to give both 0%. Therefore, the lazy one and the one who works hard, they get the same wage, basically, than the one who works hard says, why am I working so hard? And in the end, both are lazy. So this is a simple model, but it explains to you, if prices are not flexible to the downside as they are on the upside, and we can observe that this is the case for whatever reasons, then you need some inflation to get price relations into order. And if you don't have it for a long time, then you end up in a scenario like Japan. I mean, I'm an old man. I can remember very well the discussion that we had here in Europe in the 80s about Japan is so much more efficient than Europe, and we'll have all the car production going to Japan in short term, and we'll have a mass unemployment here in Europe as a result. That was in the 80s, and nowadays I hear even jokes about inefficiency in Japan. Things have changed, and things have changed in Japan for a lot of reasons, for social reasons, for demographic reasons. But I think also one of the points that led to a decrease in the efficiency of the Japanese economy is the fact that they don't have any price increases for such a long period of time. And therefore, if we are stuck in this environment of zero inflation, I fear that also growth rates will come down permanently. That we don't have just the effect of 2015, 2016, 17 perhaps, where growth rates are sluggish, but that we are stuck in a Japanese situation where growth rates don't pick up permanently. And we'll have to live with those low growth rates environments for a long period of time if central banks don't get us out of this situation. But the problem is they don't have a tool to get us out of this situation. It seems to be a little bit that in the US they are doing better at the moment because their inflation is picking up a little bit, but this is after years of growth rates way above the potential growth rate of the US. In parts of the US labor market, in those parts that are creating jobs already for the last years, we already have excess demand for labor. But you don't get as many employees qualified for these new jobs because the sectors that destroyed jobs in the big recession were other sectors and the ones that are building up jobs now. Therefore, we already have scarcity of jobs, of labor in some sectors in the US, which should have led to higher wage increases in the US, which should have led to more inflation in general. Here's Japan, by the way, price level corrected for tax effects, same as it was in the early 90s. And this is the risk that I am seeing for the world economy at the moment. And the longer we are stuck in this low inflation environment, the higher the risk becomes that central banks don't get us out of this situation. Because the longer people realize that inflation rates are low, the lower the inflation expectations are becoming. And inflation expectations are a very important thing to create inflation. If you don't expect that your competitors will raise prices, it will be much more difficult for you to raise prices. Therefore, if your inflation expectations are low, you will not create inflation. And I saw it so often in the past years that I was talking to some company which was saying, well, we can't hike prices because our competitors don't do so. And if I, a couple of weeks later, spoke to their competitors, they were telling me just the same story. Low inflation expectations will prevent inflation. The longer inflation is so low, we are stuck in a situation where it's getting harder and harder for the central banks to leave us out of this. And in the end, the risk is that we are ending up in an environment where growth rates will be low for a long period of time. And by the way, this is something, I told you the story more about the G10 currencies, but this also has some considerable effect, obviously, also on EM currencies, because on EM economies, because EM economies have been under considerable pressure in the last years. Basically, as everybody was expecting that the US central bank, the Federal Reserve, would normalize their monetary policy in due course. The Fed indicated they would start hiking interest rates in 2015. They did so, but in December, therefore as late as possible. And now we are also seeing a situation where everybody expects them to be very slow in hiking rates, in normalizing their monetary policy, because they are not in a situation where inflation picks up in the way they would have expected, and where growth keeps running so high above potential. Therefore, the US monetary authorities will be much more cautious in their implementation of normalization policies than we had expected and others had expected before, which is basically a good signal for emerging market economies. But this also means that the currencies of emerging market economies are getting much stronger now. Therefore, much of the positive effect that comes from the realization US interest rates will not go as high as we had feared is eaten up in emerging market economies by the fact that now their exchange rates are getting stronger. Most emerging market economies have flexible exchange rates nowadays. And therefore, basically we are in a situation where the positive economic effects that come from lower US interest rates, which support capital flows into emerging markets, is eaten up by the exchange rate effect. In the end, I don't think that we'll see this big blow up that some people are fearing, but we are really in a situation where we must fear that growth rates will be low for a prolonged period of time, if central banks don't find a way out of this low inflation environment, which at the moment is not foreseeable. Therefore, basically, I'm not expecting what others are expecting this big bang and the next crisis and the next 2008 recession coming up, but I'm fearing that we'll see growth rates globally which are still painfully low, which are too low, for example, to bring employment up to levels that policymakers are wishing, which is too low to really spur investment booms, and also which is too low to keep housing market booms in those regions who still have them, like in some Scandinavian economies, like in parts of Germany, for example. The low growth that we are expecting for 2016 and also partly for 2017, I fear is something we have to get used to, and those times of high growth rates are over. Now let's come to China. Times of high growth rates are over not only in the world economy, they are also, from my point of view, over in China permanently. And this is something which is quite a normal situation for China in their development process. Who could expect such a large economy to continue growing by 9, 10, 11% year by year? Obviously, it's a normalization process that growth rates come down to lower levels, and something like 7% growth rate still is not bad as an economic performance. The problem is obviously, that China has to adapt to this new situation, and China has adopted in the last years in many ways, and one of them was to open up their capital account, to open up the free flow of capital into China and out of China. This is something which normally from an economic point of view makes very much sense, and which is something which in the long run should have positive impacts on China's economic structure and therefore China's growth potential. But it's all a question of timing. And the problem that China faces, from my point of view at the moment, or the core of the problem is that the capital flow into and out of China has changed so dramatically recently. And I think this is the core problem. apart from all the shift from a export-led to a consumption-based economy, apart from all the problems in the banking sector or in other sectors, I think the core problem in China is that they are having such a big shift in their capital flows. We are seeing a dramatic change there, and I want to show it to you in one chart, which is the balance of payments, basically as a count of all the transactions that the Chinese economy as a whole has with the rest of the world. It basically consists of three parts. One is the current account, which is basically the excess exports of China to the rest of the world. This has been positive all the quarters, I've put it here in here, since 2001, has been positive in all the quarters and still is in decent positive levels. China is exporting more to the rest of the world, and the rest of the world is exporting to China with a current account surplus. This is something that has not changed very much. And if anything, it's at levels close to the good old days of the early 2000s. Therefore, everything seems to be fine here. We have to look at it a little bit more in detail. What has changed dramatically is the other account, is the other point, financial account. Basically, how much capital is flowing into China, how much capital is flowing out of China. The net financial account always has been positive in the past, apart from 1 or 2 quarters. The volatile number, therefore we always see some quarters where it has been negative in the past. But overall, the gray bars here have all been positive until 2014, where they turned negative. And the point is, they accelerated very much. Capital on a net basis is leaving China and is leaving China at an accelerating pace. This is the thing, from my point of view, that's the root cause for something is different in China nowadays than it has been in the past. And there's many reasons for it, and there are many good reasons for it, and many healthy reasons for the financial account now having dropped from positive to negative. Look, China had basically a closed capital account, and it was very difficult for capital entering China, but it was especially difficult for capital leaving China basically forever, since the People's Republic of China was created in the 1940s. But at the same time, Eric, you talked about it, China has a very high savings ratio, much higher than many other economies in the world. Therefore, we saw a situation where the Chinese economy, for whatever reason, we might discuss about this later, was saving a lot, but was restricted to domestic investment. You don't have to be a China expert to realize that this is the perfect environment for overinvestment problems. I mean, if you save a lot and you only can invest domestically and are banned from diversifying international, then you have to invest even in domestic assets and in domestic investment opportunities, even if these are not as profitable as global alternatives are. The problems that we saw in the housing market in the past, the problems that we saw in the equity market in China in the past, are certainly, to a part, the result of the structural overinvestment problem that we had in China. And now the Chinese authorities have started to open up the capital account. Capital now is, or a couple of years ago, was able to enter the country, and we have seen in the last years more opportunities of capital leaving China. You know? People can bring money abroad when they are traveling abroad. Chinese can invest in global funds in Hong Kong. There's a lot of schemes where global investment is supported and allowed. And therefore now, Chinese more and more take these opportunities to invest this huge amount of saving, not domestically, but abroad, which is a good development, I think, and a healthy development, because it tackles this domestic overinvestment problem. But the point is the scale at which authorities open up this wealth of capital being able to leave the country. And from my point of view, they've opened it up in a way which created problems. They've perhaps done a little bit too much, and capital was leaving at a high pace. And this is something which is dangerous for the Chinese economy, I think, because if capital is leaving too quickly, then you destabilize, obviously, your domestic markets. You might create risks for the housing market, you might create risks for equity markets, you might create basically risks for all markets domestically which have seen overinvestment in the past. And therefore this is something which has to be scaled and fine-tuned, and the timing here is something which is very important. And I think this rapid pace of capital leaving China is something which is very dangerous for the economy. Not the fact that capital is leaving China on a net basis is something that is good, but this pace is obviously something which is difficult. And it's difficult from a real economic perspective, because global asset markets come under pressure and domestic asset markets come under pressure, but it's also difficult from a monetary base, because somehow these capital outflows have to be financed. And the good thing about China is that they are to a large part financed by their net exports. This is something which is very much different, let's say, to the Asian countries in the 90s, where we saw the Asian crisis, where those countries that were affected, or at least initially affected, were countries that were having a negative current account. Therefore, they not only had to finance capital outflows, but also the excess imports. This is something which is much more healthy in China, but the money that the Chinese economy as a whole earns from net exports is insufficient to finance this huge capital outflow. And therefore, at the moment we have been in a situation where the Chinese central bank had to sell reserves to close this gap, and therefore we are seeing negative change in reserves. Here, basically the PBOC, the Chinese central bank, had to sell reserves just to finance the capital outflows. This is obviously something which cannot go on forever, because yes, the PBOC is the central bank on the world which has the highest stock of reserves, but nevertheless they are not indefinite, and they already have lost a good chunk of their reserve portfolio, which peaked at around $4 trillion US. They still have much, but they have lost a considerable amount. And the point was, well, if reserves are drained too quickly from a central bank's portfolio, then markets start to increase speculative pressure on it. We saw it quite often in the past. We saw it in 2008, 2009 with the Russian central bank. Before 2008, everybody was telling you, well, the Russian central bank has a lot of reserves, way too much from an economic perspective. And then in the crisis of 2008, they lost roughly 1/3 of their reserves in a quick period of time. And then suddenly everybody was speculating against the Russian ruble, because everybody thought, well, at some point they will run out of reserves, therefore let's sell ruble beforehand, and therefore gain from the expected depreciation that would be the consequence of the central bank running out of reserves. Therefore, despite the fact that they still had in 2008, in end 2008, quite a considerable amount of reserves, nevertheless, speculative pressure came up. And this is something the Chinese authorities obviously have to avoid. We see in the last 2 months, you hardly see it on the chart, but we see that the amount of reserves more or less stabilized there. We saw 2 months ago that reserves only dropped very little, and the last number even showed a very slight increase in reserves. Obviously, they are doing something against it. And what they are doing actually is taking quiet and calm measures to slow down the capital outflow. They will not change, I think, the overall policy of capital account liberalization. And they will not change the general policy of capital being able to leave the country. What they have done in the last couple of months, and obviously quite successfully, is that they are tweaking little bit the measures that they have implemented in the last years. They're making it a little bit more difficult for companies to get their capital abroad. They're making it a little bit more difficult for companies and investors to go to their banks and buy US dollars. This is not a big change in policy, and I would not expect a big announcement, we are closing down our capital account, we are going back to the situation of the 1990s. But they're doing a little bit in measures, making it a little bit more difficult, and this is obviously at the moment having an effect. And this is stabilizing. But the other point is, they still need to finance part of their capital outflow by excess exports. And this has held up very well. I showed you the current account is quite high in the chart before. Actually, the yellow bars are quite high. Therefore, they are financing good part of the capital outflow via net exports. But this has another quality than it had in the past. Exports of China, imports of China. Forget about the crisis, it was a special situation, but they were both on a rising path, and China had the luxury problem of having exports at a little bit higher level and rising at a little bit higher pace than imports. Therefore, basically, imports at that point in time were something which China could easily afford because of its large exports. China could enjoy to have imported goods instead of producing them themselves because they had such a high income from their exports. The high current account today is of a different quality. You see that exports, yes, they came down a little bit due to the global environment that we were speaking about before, but much more significantly, imports have dropped. Basically now the trade balance of China is of a completely different quality. We are now in a situation where basically China cannot afford to import as much as it did in the past because it needs its exports to finance the capital outflow. Therefore now the high current account, the high trade balance of China is something which is painful. It's something where it creates pain to export something, not to consume it or invest it themselves, just to be able to finance the capital outflow and not being able to import from the proceeds that the economy as a whole gets from the export. Therefore, we are now in a completely different situation. And yes, we see that these measures of the authorities to dampen capital outflows are having their first effects. We see it in the reserves, net is working fine. But it's only stabilizing the FX reserves given that net exports are so high. And therefore, if we don't see much stronger measures to slow down capital outflows, which, as I said, don't expect, this would be politically not feasible and would be in the long run not fitting to the Chinese overall development story, we still have to expect that net exports have to be at a higher level. Otherwise, this would be the only other source of financing the capital outflows. Therefore, don't expect the good old days of the early 2000s to come back again. For the time being, China needs high net exports to finance a good chunk of the capital outflows, and otherwise reserves would drain, which is something which would be very dangerous from a financial market point of view. We are not in a situation where basically I can tell you we'll see the good old times coming back even at lower growth rates. We have this structural problem that's tackled, and I don't expect a crisis. I'm far away from expecting a current account crisis like we saw in the Asian economies of the 90s or in a lot of LATAM economies in the 80s. No, they're able to tackle it. They have slowed down the capital outflow sufficiently to stabilize reserves, but only because the net exports are financing a good part of this capital outflow. And this is a situation which is stable, but this is a situation which is only stable if they don't pick up their imports and if they don't reduce their exports sufficiently. Therefore, from a macro perspective, I cannot give you a good story about Chinese exports. There's every motivation for Chinese policymakers to keep exports at high levels. There's every motivation to keep imports at relatively low levels, because this supports the other measures to finance the capital outflows that we have seen, and to stabilize the FX reserves, something which is of extremely high importance. Thank you very much for your attention. Do you have questions?
Thank you very much. Any questions for Mr. Leuchtmann from the floor? While they're thinking, just a quick question from my side. Do you think we have already seen any impact on the European economy from what's been happening lately, from a terrorism point of view, the political imbalances in the Middle East and so on? Or do you expect any?
Well, first of all, the European economy as a whole is very dependent on exports, and very much is dependent on exports to be able to grow. The European economy will not come out of this sluggish growth situation if global growth does not pick up. And I'm not expecting global growth to pick up. Therefore, I'm not very optimistic for the European economy. This does not mean that we will fall back into recession. At least monetary policy prevents us from this one. On the political side, certainly there's a lot of political uncertainties going on, which at the moment are more or less not having big impacts, and I don't see them immediately. I see them more indirectly. I see that, I mean, I'm paid by a bank, therefore it's very little bit difficult always to speak about the problems of the banking sector, and then not talking about them because I want to say we poor banks, we are in such a difficult situation, but this is having economic impact. Look, we're seeing a lot of regulation coming up that's regulating the banking sectors in the past, for good reasons, because we saw these difficult experiences of the 2008-2009 financial crisis. But this is having economic impact because banks in Europe, but we are seeing a similar situation in the US, they are more sensitive to business in politically difficult environments. They face sanctions, they face extra territory effects of sanctions. They are more cautious about country risks because their risk appetite has been reduced by the regulators for good reasons. But the effect is that more uncertainty in some countries prevents capital flow into these countries. And therefore, we might be in a situation where this has self-accelerating effects. This is something which is more risky nowadays than it was 10 or 20 years ago. And therefore, at the moment, I don't see big problems, but I see that we are getting into a more fragile environment, and therefore, we have to watch if we see first signs there.
Thank you. Any other questions?
Well, there's a lot of speculation in the U.S. thinking that China is devaluating their currency to improve their exports. But from the charts that I see, that actually China is really devaluating, actually selling dollars to really overcome the capital outflow. So maybe what they're doing is not to, just to improve exports, but actually to overcome this capital outflow in the country. Do you agree?
Yeah, I fully agree with you. I mean, we have been in a situation where the Chinese central bank was building up reserves in the past that you saw in this chart, where they were obviously artificially weakening their currency. These times are over. We are in a moment, in a situation where we again and again see phases like, for example, in January, where, or January and February, where they had to intervene in big style to prevent an even a much weaker renminbi. Therefore, at the moment, they are in a mode of stabilizing, which means that at the moment they have to prevent a weaker renminbi, and they're doing a lot to prevent a weaker renminbi, because if you would see renminbi weakening much quicker, then this would spur further capital outflow, and this would even amplify their problem. Therefore, in the past, I see some reason for the US arguments, but in the last, well, let's say 1.5 years, this is not true any longer. They are just in a phase of stabilizing their currency and preventing a much weaker renminbi. They will do it, and they've done it so far successfully, and I think they will be successful. We might see some further renminbi weakness, but only gradually. They will not allow a catastrophic event. They've allowed a significant depreciation last August. They've allowed significant depreciation this January. They learned that this is creating even more capital outflows, and they will prevent these catastrophic events in the future, I think, or at least do everything to prevent it. Therefore, if we see renminbi weakness, we see gradual weakness, but not because they are doing it artificially, but because they are heavily leaning against the wind, against the market pressure.
Thank you very much. There's no more questions from the floor. So thank you very much.
Thank you.